We had another weak bond auction, along with the 10-year hitting its highest level in nearly a month earlier. That's pressuring stocks. My next guest doesn't expect yields to climb much longer, though. Joining us to check the charts is BofA Securities Chief Technical Strategist Paul Ciana. Paul, great day to have you with us. Do tell. I mean, you see these moves. It feels to us non-experts like a breakout to the upside, but maybe you see it differently.
It sure does, actually, Kelly. You know, we just published a new note. The short-term technical patterns do indeed point to upside in yields, double bottom in the 2-year and the 30-year yield, breakouts in the 5-year and 10-year, and trend-following signals that suggest CTAs might get involved with the MACD signal crossing up. So we do see upside in June, but bigger picture, Kelly, I would say our base case is starting to shift towards buying the dips because our year-ahead call has been yields rebound in the first half, likely peak by the end of Q2 and begin to roll over in the second half.
Why do you expect them to roll over, or does there need to be a why? Is that just what the charts say?
Sure. Well, mostly that's what the charts say, but I can give you two good reasons off the cuff here. Number one, we view the trend in the U.S. unemployment rate as up. If you remember last year, the U.S. unemployment rate double bottomed at 3.4%, and since then it's made 3 higher highs and 3 higher lows. So slowly the labor market is starting to crack, and it recently reached a new 2-year high. When we look back at the history of 10-year yields, there have been 7 incidences where the U.S. unemployment rate makes a 2-year new high, and 6 out of 7, it was a very good medium-term buy signal in both secular bull and bear markets for treasuries.
Wow.
So that's one. The second would be the seasonality patterns at hand. Good to know is that the average trend in the 10-year yield throughout the course of the year since 1963 is up into May. It begins to top and rolls over into year ends. Now, this is a special year because January was an up month for the 10-year yields. When we look at just those years in the past, 10-year yields tended to be up until August, peaking by September and rolling down into year end. So the word patience by the Fed kind of screams itself in the seasonality patterns here. Yeah. So shifting to buying the dips this summer, being patient with the turn, but we do think it's coming certainly by the second half of the year.
But it's interesting that the overarching thing you think is happening is that we're going to have an employment slowdown. And I love the technical analysis of the unemployment rate, which we haven't done yet. I don't know why. Yeah. But that does obviously explain a lot of what could be going on. And in that case, you'd say, okay, well, then the Fed's next move would still seem like a cut and not a hike, unless they try to squeeze in a hike for some reason before that takes place.
Yeah, look, the Fed's in a tough spot, as you know, the markets have covered, right? And one side of it, you have the labor market slowly starting to weaken, but on the other side of it, you have things like commodities rallying substantially, right? And financial conditions very loose with equity markets at all-time highs, right? So there is that predicament of what is the Fed's next move? Do they support a weakening labor market and try and slow that? Or do they have to come in and squash inflation by tightening policy? And I don't have the answer to that. That's certainly out of my realm. What I do know is that in the past, Kelly, there have been 10 technical bottoms in the U.S. unemployment rate. Many of the common patterns that we talk about, the double bottoms, the heads and shoulders, the triangles, and things like that. And this would be the 11th, and it does suggest that the U rate does go above 4% this year. Yeah. And to be honest, that's actually a modest comment relative to history. History would suggest it should have broken sooner and gone further. So patient.
No, I absolutely. And I guess then the next phase of this discussion and debate moves to, how far does the 10-year fall? A lot of people think maybe not nearly as far or as fast, given that dynamic. Real quickly, you don't have anything on that yet, do you?
We do, actually. So in one of our many trend-following, strategies we employ called Elliott Wave, it would suggest that now is counter-trend wave B up and wave C down occurs next. A wave C could very easily be 38.2%, or roughly a third of the prior uptrend, which was essentially the 10-year yield from 0 to 5%. Right. So 38.2% retracement of that, Kelly, is actually 3.25%, and that is very out of consensus. Yeah. But that's something like technical academia would suggest. Yes.
Fascinating. All right. Well, that's a headline. We like a headline. And maybe it's going to be everything surprises us. Nothing surprises us anymore. Paul, thanks very much. Appreciate it.